The stock market has already wiped out $13 trillion. And the question now is, can things get even worse? Or is there actually some hope on the horizon? Well, there are three things that we have to talk about in this video. And the first isn't that hopium-filled, but maybe the second two things will be. The first is this thesis that Bloomberg Intelligence believes there is a real risk the Federal Reserve could end up having to move the terminal Fed funds rate to 6%. Right now, the Fed is talking about a peak around 4.5% to 4.75%. But then again, they told us that the terminal rate for them would be 2.8%. Back in March, that's what they would be to tell. That's what they were telling us. Oh, well, we'll get to 2.8% by next year, and that'll help the transitory inflation go away. Yeah. Well, now they've raised that by 2 percentage points, and now markets are pricing in 5% as a terminal Fed funds rate, right around 5%. However, there are more and more murmurings that inflation, at least certain parts of inflation, are going to be so sticky that the Federal Reserve is going to have to keep pushing to probably a terminal rate of closer to 6%, especially to stamp out a wage price spiral. Remember, wage price spiral is the worst thing that could happen. It is what I said back in January would cause the Fed to force a recession. They ended up forcing a recession anyway, but they will keep us in this recession even longer if we have a wage price spiral. And based on the last FOMC minutes, sort of the notes from the meeting, the murmurings about a wage price spiral potentially being an issue are coming to the forefront more so than they ever have in the past. And this is what's leading a lot of folks to say, well, if wage inflation ends up somewhere between 5.5% to 6.5%, then we need to get the Fed funds rate above that rate of wage inflation. So the 5.5%, we got to get the Fed funds rate to 6%. That means higher treasury yields and more pain for the stock market to come, because that has not been priced in yet. Remember, when we moved from pricing 3.75% in as a terminal to 4.5%, we hit new lows in the stock market. So keep that in mind. We do have this risk ahead of us about a potentially higher terminal Fed funds rate. But there is some hope, at least temporarily, for the end of the year. Let's go ahead and take a look at some charts, and then we're going to talk a little bit more about inflation. Just keep in mind, if you want to get up to 12 free stocks, you can go to metkevin.com/Webull. It's a great trading platform that I use almost every single day, especially for charting. Just go to metkevin.com/Webull, and you can learn all about it by going to that website and get those free 12 stocks when you sign up for Webull. Okay, so what do we have? What we have right here is, first of all, this right here is a chart, and I'll move my head in just a moment. And no, I'm not in a Motel 6, but thank you for the comments who suggested that yesterday. This here is a chart that looks at the S&P 500, and one of the things that I'm going to simplify this measurement as, it's basically the cost that, or how much you have to spend to hedge against downside for the S&P 500. Now, that's a mouthful. But basically, what you want to think of is when these lines are at higher levels, it's more expensive to get protection against more downside for the S&P 500. So remember, when you buy protection today, like you buy a put contract today, you're expecting there's a risk that the S&P 500 is going to go down more over the next few weeks or months. And so again, when this chart is at heights, kind of like it was over here during the COVID pandemic, it gets very expensive to protect yourself against further downside. So for example, people who bought put contracts over here in like January and February, they saw the values of their put contracts skyrocket during the pandemic. I'm sure you remember some folks, if you were trading back then, showing screenshots of how their puts basically went to the moon. That's this, essentially, right? The cost of hedging was really high. Well, take a look at this, where we sit now. The cost of hedging right now against further declines in the S&P 500 is actually at the lowest level we have seen since all the way back over here, which is actually in the 2017 box. This is pretty incredible, and it's a sign that things could actually be much worse. There could be a lot more negative bets against the market than what we're actually seeing right now. Now, some of this is potentially due to this belief that people don't have to buy as many hedges. There's less demand for hedging basically because people have already sold. If you think about it, if a lot of people dump out of the market, They don't have anything to protect anymore. The only reason you'd be playing options is to speculate rather than hedging. Remember, hedging is a form of protecting. You can downside hedge and you can upside hedge. We talk about this in the Stocks and Psychology of Money course. There aren't just downside hedges. There are upside hedges as well, which is pretty cool. But when people have a lot of money in cash on the sidelines, which, yes, even in an inflationary period of time, if you're an asset purchaser, cash is king, maybe people don't have to hedge as much. And what's interesting is if the S&P 500 goes green this month, which it rarely does, it historically is up by 2.4% in the month of just October. That is 1.8 times larger than its average decline. And that's because if in October, when things go green, they go green, baby. So there's a lot of excitement that maybe we could go green in October and finally have sort of a FOMO rally, may it be called, towards the end of the year, as people are just tired of sitting in cash and sitting out of the market, and they're worried about that potential fear of missing out of, well, what if inflation does start turning down in November and December, looking back a month, and then we're not invested in the market, right? So that is some fear that is occurring in the market right now. Let's take a look at another chart that we're seeing here. So this one right here shows us that the S&P's up days are getting more powerful than the down days. And the simple way to look at this is you just look at the right side of the chart, and you could see these little bars are getting a little bit more aggressive to the upside. And that's just a way of saying that we're recently seeing more ups or a higher percentage up than we are seeing down. So for example, let me just show you how that might work. We might say, oh, we're up on the S&P 500 2% one day, then we're down 1%, then we're up 2%, then we're down 1%, right? That would be a 2-to-1 ratio on this chart, and you could see we're actually somewhat starting to approach that. And so that is another potential sign of at least some temporary market bullishness. Here's another one as well. Open interest in the S&P 500 index puts has been waning next to calls. In other words, when you look over here, the blue line represents call option purchasing, and you could see how this is actually starting to peak a little bit, whereas here you're seeing a little bit of flattening in the put contracts. So I think that's somewhat interesting. We're seeing a little less on the put side, a little more enthusiasm for potentially rallies towards the end of the year. And when you sort of divide those as a ratio, you could basically here see in a more simple way that the level of betting against the market compared to the level of betting for the market is falling. So less bets against the market. But is there a reason to actually be hopeful, or is this truly just going to be some kind of FOMO rally? Well, let's take a look at what JPM talks about. So first, JP Morgan, in one of their recent research papers from just a couple days ago, talks about this risk of that wage price spiral, which I've been talking about all year long, and we just talked about earlier in the video. And one of the things that I think is interesting is they make this argument that, oh, well, we actually think the Fed's rate hikes are going to pressure down the wage price spiral risk. Now, in fairness, I met somebody from JP Morgan who's one of their VPs of doing this sort of research, and he used to work for the Federal Reserve. I met them back in January, back when I sold, which was remarkable. And back then, he said, well, right now we're pricing in a 0% chance that there could be a wage price spiral. And I'm like, yeah, I think you're wrong, but okay, we'll see. And now we're actually talking about, oh crap, here comes the potential for a wage price spiral, right? So take everything with a grain of salt that you hear out there. Ultimately, you have to make your own decision, right? You only have yourself to blame or yourself to reward when you do something right or wrong. This is interesting, though. A course member posted this. Remember that I encourage you always to join the courses on Building Your Wealth link down below. We've got a great community. One of our community members posted this. Just the term layoff in Google Trends. We're starting to actually see that trend increase this year. Now, when we look at it relative to a 5-year norm, it's probably in line with what you saw in 2019, so no real signs of distress, and obviously a lot less than what we saw during COVID. But one of the big things from the JP Morgan report is that, and I really wanted to extract this as well, is, hey, JP Morgan, how do you actually think that inflation is going to go down? How can we have hopium about inflation? And what I found here was the following. JP Morgan argues that what we might see by September of 2023 is a reduction of certain categories of inflation in substantial measures. So core goods, which represent about 27% of CPI, they expect to be down 2% by next September. So in other words, we would see a negative, a deflationary print for core goods, and that largely being driven by new cars, trucks, and used cars and trucks. But when you go to core services, they actually still expect that services will be up 5.4%, which isn't so great. That represents more of our core. That represents about 72% of our core. And what's remarkable is what actually anchors this down is a decline in potentially health services costs. But they still note that by September of next year, shelter inflation could be substantially high. Now, we've done a very detailed video on shelter inflation and the dangers of really inflation continuing to strengthen because of shelter issues, and that's because what we see here is the CPI measures for shelter lag so much, they're so slow that we get this CPI read for inflation, that's this blue line right here, and models estimate that we really don't actually expect it to trend down substantially until probably in the 2024 region. And it's just a very slow move down, which is quite unfortunate. So even as other aspects can really trend down, and we are seeing that. I mean, we're seeing container prices, shipments from Shanghai to New York or to LA, all of them are plummeting here in 2022, which is really phenomenal. We are seeing wheat prices trend down, although recently they've somewhat started having this sort of little bit of an uptrend shelf over here. That could be just because prices got a little bit oversold there. But you could really see here we're well off those Ukraine war peaks. And then, of course, the used vehicle index down about 18% right here. That's the orange line, the CPI being the blue line, which usually lags by about 2 months. So you do have hopium that inflation is going to trend down, and JP Morgan talks about exactly that lifting of bottleneck pressures and hope on inflation, but they make it very clear that, look, we could still see elevated inflation because of shelter inflation. So sure, are there reasons to be hopeful? Are there reasons to say, hey, yeah, we might be at the bottom, let's get in some bullish call options, let's get a little bit more aggressive in deploying cash? Maybe that's a good idea. Personally, I'm a big fan of having some form of a diversified approach to the markets. Generally, what I recommend to most folks is sort of not personal financial advice, but in a broad measure, is just have a balance of index funds, and then add some salt and pepper to your portfolio by adding some exposure to some of your favorite stocks or maybe some of your favorite active ETFs or whatever. But what I personally like to do is I instead of having index funds as my diversification, I like to use real estate as my diversification. So I've always been a fan of, let me try to get half of my net worth into real estate and then half of my net worth into the biggest and best, maybe 5 to 10 companies, sort of little 5 to 10 punch cards, like Warren Buffett says. You've got 20 in your life, so you pick your favorites. And for me, that's diversification enough. But then again, I also have, if my stocks go to zero and my real estate goes to zero, I have income that can substantiate my lifestyle. So that's going to be different for other people. But I like to use real estate as a diversification. For me, that method of diversification is house hack. I'm not going to have any more personal rentals. Probably sometime next year, I've got 2 more to get rid of, and everything will be in house hack, and that'll be my real estate diversification, which I'm really excited about. And I can't wait to get all non-accredited investors in it as well. Remember, non-accredited investors, tentatively, we're expecting will be able to join somewhere around January, February. Minimum investment $20,000. Details at househack.com. If you're a course member, we expect the minimum will probably drop to about $5,000 because we feel like you'll be part of the community and you've got a lot of education in those courses. It's really, really incredible. And then if you are if you are an accredited investor, you can get in now with a $25,000 minimum. And the beautiful thing about that is you get the option to take advantage of the warrants that we have, which are kind of like call options, and you can learn more about those at househack.com. Just make sure you join before October 31st to get the most warrants possible. All right, folks, thanks so much for watching. I don't know. Let me know what you think in the comments down below. Personally, I do think there is more upside risk to interest rates. But look, the hopium of inflation potentially peaking, and signs that inflation is trending down, as well as the temporary hope that maybe we'll have a post-election rally. I have that hope too. But then again, we've had hope that inflation would be peaking for quite a while, and that shelter inflation still makes me quite nervous. So we'll see how much more downside we actually end up having. But for me, I'm in, and I'm adding. So thanks so much for watching, and we'll see you in the next one. Good luck and goodbye.